Hey, traders! Welcome back to the channel, where we dive deep into the world of trading to help you navigate the stock market like a pro. If you're new here, make sure to hit that subscribe button and turn on notifications so you never miss an update. In today's video, we're going to talk about one of the most crucial aspects of technical analysis: chart patterns. These patterns can help you predict potential market movements and make better trading decisions. So, what exactly are chart patterns? Simply put, chart patterns are shapes and formations that develop on a stock chart, created by price movements over time. They give us clues about what the stock might do next. The beauty of chart patterns is that they can often signal whether a stock will continue its trend or reverse direction. Today, I'll be walking you through some of the most common chart patterns and what they mean. First off, chart patterns fall into two main categories: continuation patterns and reversal patterns. Continuation patterns indicate that the current trend is likely to continue, while reversal patterns suggest that the trend might change direction. Let's start with continuation patterns. These patterns form when the market takes a brief pause during an ongoing trend but then continues in the same direction. Here are the key continuation patterns to look out for. The first one is the flag pattern. Imagine a flag on a pole. This pattern consists of a sharp price movement, called the flagpole, followed by a rectangular consolidation area, which forms the flag. The pattern can be bullish or bearish, depending on the direction of the flagpole. If the price breaks out of the flag in the same direction as the flagpole, that's your signal that the trend will likely continue. A good example of this would be when a stock sees a rapid price increase, then trades sideways for a short time before breaking out upwards again. Notice in this chart, the stock price shoots up sharply, then consolidates within a narrow range. This consolidation phase creates the flag, and once it breaks out, the stock continues to rise. Next, we have the pennant pattern. Pennants are similar to flags but have a triangular shape instead of a rectangle. The consolidation period is shorter and tighter, and the breakout happens much faster. Again, a pennant can be bullish or bearish, depending on the trend direction prior to the pattern. As you can see here, the stock makes a sharp upward move, consolidates into a small triangle, and then breaks out to continue the trend. This indicates that the stock may see another sharp move in the direction of the previous trend. Let's talk about triangles. Triangles are formed when the price begins to consolidate between two converging trend lines. There are three types of triangles: ascending, descending, and symmetrical. In ascending triangles, the price is making higher lows but struggles to break a resistance level. When it finally breaks that resistance, it's a strong bullish signal. On the other hand, a descending triangle shows lower highs with a consistent support level, which often leads to a bearish breakdown. In this chart, we have an ascending triangle where the stock keeps hitting a resistance level but making higher lows. Once the stock breaks that resistance, it sees a significant move upward. Now, Let's talk about one of the most well-known bullish continuation patterns, the cup and handle. The cup and handle pattern forms when the price makes a rounded U shape, resembling a cup, followed by a smaller consolidation phase that looks like a handle. This is a bullish continuation pattern, meaning the price is likely to continue moving higher after the handle forms and breaks out. Now that we've covered continuation patterns, let's move on to reversal patterns. These patterns indicate that the current trend is likely to change direction. One of the most well-known reversal patterns is the head and shoulders. It's called this because it looks like a head between two shoulders on a stock chart. The first shoulder forms when the price hits a peak, followed by a higher peak, the head, and then another lower peak, the second shoulder. Once the price breaks below the neckline that connects the two shoulders, the stock is likely to move lower. Next up, we have the double top and double bottom patterns. A double top is a bearish reversal pattern that forms after a stock makes two peaks at roughly the same price level. A double bottom, on the other hand, signals a bullish reversal after the price forms two troughs at a similar level. Triple top and triple bottom patterns. These are strong reversal patterns. A triple top occurs after an uptrend and signals a bearish reversal, while a triple bottom occurs after a downtrend and signals a bullish reversal. A triple top is formed when the stock reaches the same resistance level 3 times but fails to break through. The price will form 3 peaks at roughly the same level, and once it breaks below the support level, it indicates a bearish reversal. In this example, you can see the stock trying to break through resistance 3 times but fails each time. After the third failure, the price breaks the support level, and the stock moves lower. This is a strong sign that buyers are losing control, and sellers are taking over. On the flip side, the triple bottom is a bullish reversal pattern that forms after a downtrend. The price tests the same support level 3 times but fails to break below it. When it breaks through the resistance level after the third touch, it signals a reversal to the upside. In this chart, you can see the price hitting the support level 3 times before finally breaking through resistance. This tells us that sellers are losing strength, and buyers are likely to push the price higher. Now let's move on to wedge patterns, specifically the rising wedge and falling wedge. These are both continuation and reversal patterns depending on the context in which they form. A rising wedge typically forms after an uptrend and signals a bearish reversal. The pattern is created when the price makes higher highs and higher lows, but the highs are increasing at a slower pace than the lows. This indicates that upward momentum is weakening, and once the price breaks below the lower trend line, it's often followed by a downward move. Thanks for tuning in today. If you found this video helpful, make sure to hit that like button and share it with other traders who want to improve their technical analysis skills. Drop a comment below if you've used any of these patterns in your own trading and how they worked out for you. And if you want more content like this, be sure to check out my previous videos on candlesticks and other chart patterns. Until next time, happy trading, everyone.